Hello everyone, welcome to my channel. Today I have to talk about very important topic in personal finance, that is mutual funds. Many people have heard about mutual funds, SIPs, equity funds, debt funds and index funds, but I have lot of people still have a basic questions. What exactly is a mutual fund? How it does work? How do mutual funds make money? What is SIP? Is mutual fund investing safe? How much money do we need to start? And most importantly, how can beginning start investing in mutual funds? In this video, I am going to explain mutual funds from A to Z very simple English. So let's start. What is a mutual fund? First, let's understanding basic meaning. A mutual fund is an investment vehicle that collects money from many investors and invests that pool money in different financial assets such as shares, bonds, government securities and other securities depending on the objective of the mutual fund. Let me give a simple example. Suppose you have 1,000 people each investing 1,000 rupees. 1,000 people is investing 1,000 rupees. Together they have 10 lakhs rupees. Instead of every individual investor selecting and buying different securities on their own mutual fund, collects this money and invests it according to the fund's investment objective. So, in simple words, many investors pool their money, funds the money, investors receive units. Many investors pooled their money, funds invest units, so investors receive units only. That is the basic concept of the mutual fund. Who manage the mutual fund? You may ask the question. If money, if you invest money in a mutual fund, you actually manage it. Mutual funds are managed by professional investment managers and their terms and their teams. The study the market companies, sectors, interest rates, economic condition and other factors before making investment decision according to the fund's stated objective. The mutual fund itself is generally operated by an asset management company, commonly called an AMC. AMC means asset management company. For example, there are AMC in India that offer different categories of mutual funds. The important point is that when you invest in a mutual fund, you are not personally selecting share or bond. The fund follows its investment strategy and it's managed professionally. What are mutual fund units? When you invest money in a mutual fund, you don't directly receive shares of every company in the fund. Instead, you receive mutual funds units. The price each of unit is called NAV. NAV means net asset value. For example, suppose the NAV of mutual fund is 20 rupees. If you invest 1,000 rupees, 1,000 rupees divided by 20 rupees is 500 units you have. So, you would receive approximately 500 units subject to applicable charges and transaction details. If the NAV ladder increases, the value of investment increases. If the NAV decreases, the value of investment decreases. What is NAV? NAV stand for net asset value. In simple terms, NAV represents the per unit value of the mutual fund. The value of funds investment changes every day because market price changes. Therefore, the NAV market linked mutual fund can also change. For example, you purchase 500 units at a NAV 20 rupees, 500 rupees, 500 units at a NAV of 20 rupees, your investment value is 10,000. If NAV become 25, 500 into 25, 12,500. If the NAV fails to 18 rupees, 500 into 18 is equal to 9,000 rupees. This way mutual funds investment and this is why mutual funds investments, especially equity mutual funds, can go up and down. Where does, and can I ask a question? Where does a mutual fund invest? Different mutual fund invest different types of assets. Some funds invest mainly in equities, some investment bonds, some invest in bonds and other fixed securities. Some invest in government securities. Some follow as index. Some invest in combination of classes. This brings us difference to categories of mutual funds. Sixth question you have raised. Main types of what are the main types of funds? Let understand the major categories. Equity mutual funds. Equity mutual funds primarily invest in shares of companies because the investment equities their values can fluctuate significantly. They are generally considered more suitable for investor you have longer investment horizon and can tolerate market volatility. Or next one is debt mutual funds. Debt mutual funds invest mainly in fixed securities such as government securities, corporate bonds, and other instruments. Their risk and return characteristics are differently from equity funds. However, debt funds are not same as bank fixed deposit and they are not completely risk free. Hybridly, and another one most probably so many investors are selected for hybrid mutual funds. Hybrid mutual funds means hybrid investments in combination of equity and debt and other asset classes. The objective is create a portfolio with mixture of growth potential and relatively more stable assets depending on their particular schemes. And also another one is basically you can ask about index funds. An index funds generally tries to replace the performance of a particular market index. For example, an index fund track an index such as Nifty 50 instead of actively selecting stocks to outperform the index. The fund generally follows the comparison of the chosen index. Other categories there are also such categories as large cap funds and mid cap funds, small cap funds, flexi cap funds, ELSS funds, sectoral and thematic fund, liquidity fund, and other many categories. Each category is different objective and risk level investment strategy. Therefore, investors should understand category before investing. These are the main topics. Please subscribe and like in this video. Please useful to share so many friends and your colleagues. Thank you for watching. Thank you for everyone. Thank you.